Welcome to Big Business This Week. I'm JD Durkin here on the trading floor of the New York Stock Exchange. Another busy week in the world of business, finance, and the economy, to say the least, from how the ongoing conflict between Israel and Iran is impacting the U.S. and the global markets. Plus, weaker than expected retail sales numbers out this week and what it means for economic uncertainty. And if you've ever wanted a Donald Trump branded cell phone, now could be your time to buy. Lucky you. Here to help us break down all that and so much more is Jess Inskip, host of the Market MakeHer podcast and the director of investor research at stockbrokers.com. My friend, it's great to have you. Thanks for joining us this week.
Yeah, I'm happy to be here, JD. So much happening within the markets, even though the market's not moving too much on it, but it's still a lot to discuss.
Well, that's an interest. So let's actually start there. And obviously, you and I are having this conversation on Fed Day. Happy Fed Day, by the way. We always love hearing from Chairman Powell. So we'll talk a little bit more about the chairman and the FOMC's press conference in just a bit. But first, the impact on the markets from this conflict in the Middle East over the last week. We've seen oil move up. We've seen gold remain near all-time highs. Equities, like you said, they're kind of taking everything in stride, and I'm wondering what is standing out most to you when you look at the market over the last week, Jess.
Well, so I was thinking that the market was looking for some type of catalyst, which would come today with what happened with the Fed, but literally the market was unchanged. And the market being the stock market, even the bond market was rather tame. Everything altogether seemed really tame. So what I think the market is paying attention to is we're just looking for and searching for any type of clarity. We've reached what I like to call the ceiling of uncertainty, which requires a catalyst to go higher. We had a really great earnings season. We've got a wait and see Fed that I know we're going to break down even further. So the market's waiting on something to send us higher. That something, of course, is unknown. Otherwise, we would be there because the market's a forward-looking machine.
You know, oftentimes I think when there are geopolitical conflicts that emerge around the world, sometimes the U.S. financial system doesn't really pay attention to it very much until it has to.
Sure.
I would argue this is obviously there's oil's much more in the equation here given Iran's exposure in that market. What will you be looking for as the conflict between Israel and Iran continues from the lens of impact on the financial markets?
So I want to see how financial markets adjust and how they react. That's what I want to interpret. I like to look at the data. And a lot of that is really velocity of change of movements. We saw that a little bit with oil. But oil still isn't, it's not going any higher. So there's still some lack of conviction. And I point that back to even the inflationary aspects because Powell commented on that today. He says that oil shocks, if it's just this one-time oil shock, it's not necessarily going to make its way into inflation. So he's not even worried about that. And if we're looking to how this is going to impact the overall inflation picture, which is going to impact the overall economy and impacting the consumer. And if the person who's telling us, making those decisions on Fed policy and interpreting how everything flows into that inflation data is telling us it's a non-issue, I think that's what's happening within the market. So what I'm watching specifically is oil, is that going to go higher? Is there volatility there? Is there sudden volatility increase in the VIX? And more importantly, paying attention to the bond market. What's the action there?
What do you make overall of kind of how resilient the market has been insofar as even if we don't have these mega days of gains, and I guess I'm referencing a bit more on the equity side, even if you don't have these mega 1.5-2% days, they're not rallying necessarily, but even despite maybe a bit of a muddled picture or mixed guidance or a backdrop of uncertainty, which is certainly the word of the year, that for the most part, we're still sort of just trading sideways in a pretty narrow range right now.
I prefer this sideways range as we recalibrate rather than this volatility. Volatility is uncertainty up and down. So you're right, uncertainty is absolutely the word of the year. And Powell even said it's diminished, which I find very, very interesting, which I know we'll talk about. I'm obviously itching to talk about Powell. But nonetheless, I sent you a really great chart, and I love marrying technical analysis with events because it shows you how fundamental analysis can even go into a certain type of view. If we were to go to the first tariffs implemented, not when they were discussed, but the first tariffs implemented, I believe it was on February 3rd, and look at the opening candle of that day. It's around the 59.68 level. That was the ceiling of uncertainty that we couldn't overcome for quite some time. We're about there and staying above that, and earnings was the catalyst that kept us there. But what's even more interesting, so I'm calling that tariff uncertainty. We want to understand how tariffs are going to ultimately impact the consumer and the inflation picture and that supply and demand. If we were to go all the way down to the lows post-Liberation Day and see where we bottomed, so that lowest point where we bottomed on the lows, go all the way back to February of 2021, or January of 2021 actually, and look at where the market opened as soon as the Fed indicated that they were going to be restrictive. So thinking that line right there, we went into this pretty bad bear market, the last bear market that we overcame from the AI rally. That line in the sand to me would erase any type of progress that we've made on inflation. We did not go below that line, but that's exactly where we bottomed. So what I'm trying to say here is I'm looking at this range-bound market, and we clearly have had an upward bounce and a downward bounce. That upward bounce coincides when tariffs were introduced, but that lower bounce coincides when we were introducing a restrictive Fed policy going all the way back to 2021. So I find it very, very interesting that these levels are lining up with the market, and that's certainly something I'm watching very closely.
And of course, you mentioned monetary policy. What better day to talk about Jerome Powell than one of the rare days that we get to hear from him? Unchanged in terms of the interest rate decision, that was pretty much baked in. That's not a big surprise.
Sure.
But the committee's still projecting 2 cuts this year. What was interesting to me is that you do have more participants now in the FOMC than you did the last time we got a dot plot or a summary of economic projections. You now have 7 of the 19 who indicate no cuts this year. And that number is higher. So while overall we're still kind of in this narrative of 2 cuts of 25 basis points between now and the end of the year, as Powell says, we'll stay data dependent, but maybe that internal narrative is starting to shift a bit. What most stood out to you from a very exciting day? Because we love this stuff.
I do love this stuff. I always say it's like, if you're a Taylor Swift fan, we always go into what Taylor Swift says and dissect to understand. We do the same thing in finance, and I find it so interesting. There was a couple things that stood out to me. One, with the policies in the dot plot, this is the dot plot that we received post-Liberation Day. The one that we received in March, we hadn't had that yet. So we were trying to understand the effects of tariffs. That's really the goal here. And the commentary was more important this time, and it's increasingly become more important. The additional voting or projections within the dot plot is showing to me policy uncertainty, which then translates to policy volatility. And diving deeper into the commentary, I think you can always find one nugget that he says that gives us an indication of what we have to focus on and some data that we can pull. And he did give it to us again this time, which I very much appreciate. We want to understand the impacts of tariffs on inflation. That's the ultimate goal. It's long and variable lags, as all policies, as we say in the market. But as we're looking at the manufacturer, the importers, the exporters, the retailers, and then ultimately the consumer, someone is going to absorb those tariffs. We don't know where, and we don't know how, and how it will affect the end consumer. And if it's somewhere before the end consumer, then of course that's pressure on profit margins. So there's a lot to digest there, and that's leading to the uncertainty. But the way he worded it, going back to that volatility or SEP disparity of data and forecast, we'll begin to see those normalize or be less volatile, less dispersed, and that will allow them to go back to normal Fed policy, meaning this tariff impact is, if we were looking backwards, you would arguably say we need a cut. But we're looking forwards to understand the impact of inflation. Through survey data, it is very indicative that there is an impact of inflation. We just haven't seen it come through in the data. He wants to see that coming through the data to understand the exact level of the impact. And once we understand that, we should see some less disparity within the dot plots, and then we would get more clarity. And he's saying, so that's the nugget. That I know that was a long-winded answer, but that really stood out to me. Now I know exactly what to look for. And he's able to stay in wait-and-see mode because he says the economy is resilient and strong, and that's the cushion where we can afford to wait and, in his words, learn more so we can make better decisions.
Yeah, I thought that one of the most, and I'm glad you said that last part especially, because one of the most telling lines to me was when he said, "We are well positioned to wait before considering adjustments to our stance for monetary policy." On the day when the president is out there on the South Lawn of the White House, President Trump, and he's sounding off to reporters, echoing his longtime running criticism of the Fed chairman, who is somewhat beleaguered now, I would argue, at least in the minds of the president. And you know, that was an issue that we knew Powell was not going to touch. We knew he was going to be asked about it. You know, did you see the tweets from the president, plans to step down? I remember one reporter today asked him, even if you serve out your term to 2026, would you stay on as a governor? And you just get the sense, I mean, this is such a disciplined messenger, isn't he? I mean, it's for a union, and he is this kind of lifelong Washington, D.C. guy, right? He doesn't have the normal background of a traditional Fed chairman, but I feel like does a really effective job completely insulating himself from politics in a uniquely political town. How do you feel like he's going about that part of it, the Trump elephant in the room?
I think he did a great job, down to the details, wearing that purple tie so consistently. watch those signals. I find it very, very interesting. He is a big fan of Paul Volcker. And Paul Volcker, if we study that era, is price stability overall. That's when the dual mandate came about with maximum employment, and price stability is right around that time or slightly before. And the thought is price stability overall, because in the long run, even if there is pain to the unemployment picture, it's better for the employment picture when we focus on that. And I always keep that in mind when I'm considering Powell. He was asked at an economic forum a little while ago who was his favorite chairman, dead or alive, and he stated Volcker very, very quickly. And that's why I think we relate a lot to stagflationary concerns and that type of environment. But Volcker was not political. He was very, it was not a good environment for him, because he did what he had to do within the circumstances in order to tame inflation and to anchor inflation to 2%. And I think Powell, mix them up, which is hilarious, really focuses and tries to emulate on Volcker. But he does a great job being non-political. He focuses on the dual mandate, and even when he asked that question, he said, that's not what I'm considering right now, being if I'm going to be governor. Right now, the task at hand is price stability, and that's what I'm focusing on. And I think he does a great job.
And I agree with you. I think any of us would argue Jerome Powell is truly the Taylor Swift of our industry.
Yes, he is.
Is there a bigger rock star? And he is, obviously there's been long-running criticisms of the Fed. Maybe they were too late to start the previous cycle on interest rates. I've been wondering this question because we've heard a suggestion from the president that at some point President Trump plans to name his own nominee to the Fed, presumably long before Powell's term is set to end in 2026. And I've been kind of kicking this around the back of my head a lot. At what point does the market, if that happens, and we would have to assume that President Trump's next pick for the Fed would be someone who's more, we'll put this delicately, more aligned with his own version of, monetary policy, right? It's a nice way of saying the president would look to install someone who would do what he would want to do on rates. At what point does the market then start to take more of a signal from what that person says as opposed to what Powell says, even if Powell is still in the job?
Well, Powell's making the decisions, but the market's a forward-looking machine. And this is what's been going around my head with that, JD, so I like that we've shifted the conversation there. It's so important that the Fed is not political, because their tools, and when they're trying to tame inflation, they're ultimately trying to slow down the economy. And they don't want to do that too much, too fast, otherwise they put us in a recession. And sometimes the recessions, if we look at history, is what we needed to tame inflation. It doesn't matter where you fall in the political spectrum. You don't want that under your presidency. You don't want a slowing down economy. That's why it's so important that they remain non-political. Now, what I find very difficult with this current situation is the perception of being political is absolutely critical, down to that purple tie. So if we have the current administration making tweets like this, or whatever we call it now with X, then I really like to advocate for calling it yeets, to be honest, but nonetheless, it creates a conflict because he cannot even create the perception that that is implicating any of his policy decisions. If he were to lower rates today, just in response to any type of quote from the administration, that could cause calamity within the markets because we're thinking the Fed is going to be political and we need price stability, which means stability within the credit market. We've had volatility there. So the concern is, and the way I would be watching market action very specifically, is the fixed income market and the credit market. Whenever that nominee is made, how are they reacting? Are they going to depict this as political or the right thing to do? Because in the short run, if we do lower interest rates, sure, that's going to spur growth. But in the long run, we could have some really bad inflation problems if we're not calm and calculated and focus on price stability above all.
Yeah, the bond market, it's a different instrument. That was so interesting to me after the Liberation Day framed sell-off, because that was a rare moment that I caught President Trump also on the South Lawn talking to reporters, and he somewhat conceded defeat. He admitted defeat a little bit, and he indicated, you could tell that the Bessents and the Kevin Hassetts of the world were in the presidency are saying, you may frame the drop-off in equities as we're prioritizing Main Street over Wall Street, but the bond market's not going to lie, and the bond market's going to tell you a different story. So I think that's a great point. One thing that Powell did talk a little bit about today, and I would love your take on this, what do you make of the divergence, the split we've seen overall between the hard data, things like labor data, spending, et cetera, and the consumer sentiment surveys, aka the soft data? Largely, they've been telling kind of different pictures.
That they have. Well, he said that the soft data has really peaked, which is that consumer sentiment and feelings of the impacts of tariff and inflation. That is definitely a good sign. And I like to go back to, I suppose, a lot of history now that we're having this discussion, JD, but Alan Greenspan, his definition of what price stability is quoted by Powell quite often. And his definition is when consumers and businesses aren't considering prices when making decisions. Arguably, that definition is interpreted by soft data, or validated by soft data, if you will. So I think sometimes he says conflicting things, and I like to focus on that. What I find interesting about the disparity is the way that he changed his wording. We like to look at that. In the previous March statements, or previous May statement actually, there was a statement that said uncertainty is elevated. Now, uncertainty has been subdued a little bit. And that uncertainty now, where that statement's coming in, because there was a question on the commentary, is related to soft data. So now we understand where uncertainty is coming from in the lens of Powell and the FOMC is soft data. And now he says the hard data, as we're seeing it, is still healthy in terms of looking at it more broadly in a variety of economic indicators. We have a very healthy economic environment. We still have modest growth, and that paints a really good picture. There's still disparity within the soft data versus the hard data. However, the soft data has peaked and is looking better, and often is a forward-looking indicator, but not necessarily an accurate indicator. We can go into a lot more detail about that too.
Well, we have just a minute or two left, but I do want to get your take on something in the media space. I found this interesting, really interesting this week, that for the month of May, for the first time ever, streaming surpassing combined broadcast viewership and cable viewership. Jess, you are a prolific content creator. I feel like you understand the game of where streaming meets social media, going to an audience where they are better than anyone in our game. Was this inevitable that at some point the lines were going to cross in the great decline of cable overall?
I believe so. Consumers change, markets change, we adapt, and we evolve. And that is absolutely a component of it. We like more personalized content. We like to binge content. I even cannot stand it when I'm watching a show, even on Netflix, and they make me wait another week to see something else. It just drives me crazy. But mass consumer behavior is geared towards that. So of course it was inevitable. It's just going to be interesting to see how things that were on cable are making their way to the streaming platforms, and that the convergence there, I think, is the next leg to watch.
Yeah, if you don't mind me asking, a bit of a personal question. In the Inskip household, Are you all like a Disney Plus family? You tend to lean into the Netflixes of the world. A lot of people are watching on YouTube. They're seeing record numbers as well.
Yeah, we actually have almost every single one of them. We are a streaming family. I don't watch on YouTube, but I do have Disney Plus. I do have Hulu as a result of Disney Plus and Netflix, Amazon Prime, Paramount, actually Peacock. I have HBO Max or whatever it's called now. Too much.
Yeah, I'm so much like you. It's like I look at my statement at the end of the month and I was like, wow, that's so many of them. Many of them. But it's an important conversation. Finally, before I let you go, my friend, one story that you're thinking about in the world of, it could be personal finance, the overall economy, the markets, that you think we should be paying a little bit more attention to.
The biggest one absolutely is stablecoins. That I've been ringing the alarm on that now for the past couple of weeks, especially with the passing of the Genius Act today. But there's so much evidence with DJT investments, with what's happening even around blockchain and the shifts of infrastructure. So I think this AI rally is no longer going to be the AI rally. We're going to rebrand it to the efficiency rally. Anything that goes to increasing efficiency enhancements, productivity, if you will. And part of that is stablecoins. It's an efficiency metrics to move things around, but that also leads to a disruption within the fixed income market if we're requiring to have a lot of issuance on the front end of the curve in regard to treasuries. We have a deficit problem. We're issuing more debt. We were wondering where the demand is going to come from. Would it come from the Fed's balance sheet? Well, now we have this new product that's requiring you to buy a lot of treasuries, at least on the front end of the curve. That's a disruption to the fixed income market, but it's also a disruption to a lot of other aspects within consumers. So it's definitely something to pay attention to.
Yeah, of course, we just had the highly anticipated, it took several years to get there, but the Circle IPO. Of course, they're responsible for the USDC. We talk a lot about that being pegged 1-to-1 for the dollar. The IPO was absolutely through the roof. It was up and to the right again today off of that news, and an exciting moment for the New York Stock Exchange to finally get them going public. And you're right, I think that's a great story. And we'll have to have you back. We'll do an entire stablecoin related interview. But we'll have to leave it there today, my friend. That's Jess Inskip, host of the Market MakeHer podcast and the director of investor research at stockbrokers.com. Jess, thanks a lot.
Yeah, thank you for having me.